We want to welcome you to our educational event here, complimentary of divorce in the home is our workshop topic today. And certainly the home is, if you live in California, particularly one of the biggest, things that needs to be, resolved and agreed upon, whether you sell the home, buy the other person out, or, agree to maybe be co-owners at some point, or equalize it some way with the assets. So that's the subject of our discussion today. I want to first off have you give yourself a pat on the back for being here. Many of us here in the Vesta world and here in Irvine have walked down your road, not in your shoes, but down your road of divorce. And we know that it can be certainly taxing emotionally, physically, and mentally. Well, give yourself a pat on the back for being here. It can be very hard, sometimes hard to get out of bed. In doing so, it means that you've taken the first step towards taking charge of your life and embracing the situation you find yourself in, and getting yourself prepared for the next chapter of your life. I'm a CDFA, a certified divorce financial analyst, a mediator, and a wealth asset manager, but I identify somewhat like a coach. And a coach tells me that, there are better days ahead for you. And we've seen it happen time and time again. So Vesta was created almost 10 years ago in New England. And we were formed because we believe the divorce market is largely broken. It's combative, it's confusing, and it's costly. And we wanted to take some of the angst out of it. So we came up what we call the Vesta collaborative style. We put together professional hubs like the one you're attending here in Irvine, comprised of the skill sets that people generally need when they go through divorce. So an attorney or a mediator, a CDFA, which is a financial advisor who's trained specifically in marital asset division and identifying all the things that have to do with the financials of dissolving the marital enterprise, a realtor, a mortgage lender, a broker, and a licensed marriage and family therapist or a divorce coach. Those are the core skill sets, but within the Vesta world, we have CPAs and forensic accountants and business valuation people and trust attorneys and parenting coaches and career coaches, just about anything you would need to go through divorce. I mentioned, I operate like a coach. I do have a long, extensive background in sports, and I believe very firmly that you're much better off with a team than you are individually. When I went through my divorce, I had all the skill sets that I just mentioned. I had them all, but guess what? They were siloed. They didn't work together. So the Vesta collaborative style allows you to leverage the skill sets of the people in the group. Now, you can work with any one of us, any combination of us, or all of us. If you have people outside our ranks, we'll work with them. But if your professionals are working together, collaborating, modeling, sharing data and information, ultimately it's going to save you time. And it's going to give you more of ability to make informed decisions. And I would espouse that, one of the biggest things that I say people should put themselves in a position of is to be able to make an informed decision. So you know the impact of those decisions when you come out of it on the other side. We know we're doing something right because we've grown across the country. Many of us here were on the beachhead when we started in Southern California 4 years ago almost. And we've grown all over the country. So we know we're doing something right. One of the things is that we put on these educational events, which you're invited to come back to as many times as you'd like to. But what I really urge you to do is to reach out to one of us or any of us or all of us for a consultation, because we can only give information in a general nature in this educational forum. We will have an individual consultation will allow us to talk more specifically about your particular situation. And we do say divorces are like snowflakes. Everyone is different. Everyone is different, but they all have some commonalities that need to be addressed. If you remember even 10% of what you've heard today, that's good. We're going to give you a lot of information. You're invited to come back as many times as you'd like to. Last thing I'll say is all the professionals here, my colleagues, have all been highly vetted, gone through a strenuous background, interview and application process. We all have our own practices, but we come together for a divorce for the purpose of working collaboratively, helping people navigate this circumstance. So with that, I'll ask you to pay attention, and hopefully you are able to walk away with a few nuggets that help you moving forward.
All right, so I'm just going to go through a disclaimer for our information today, and I think that someone's going to share our slides with you in a moment. But the purpose of our program is to provide helpful legal and other information. It's difficult, if not ill-advised, for our professionals to provide detailed, specific advice. And the reasons are that, like Len was saying, each of your cases are unique and fact-specific, and there are nuances and details that we don't have the privacy or the time to flesh out. So our professionals adhere to the highest ethical and professional standards, and they must be cautious about issues of potential conflict of interest and fulfillment of professional ethical responsibilities in a limited time format like we have today. So that said, we'll do our best to give you important information that'll clear up some of the confusion and uncertainty about divorce. However, some questions may just be better suited to a private consultation with one of us. So we thank you for your understanding. Hope you'll not be offended if we can't answer your question after with everybody, and suggest that you schedule a private consultation. So please understand that the information we give is to be considered educational, informational, and general in nature only, and the discussion and the question and answer exchanges shall not create an attorney-client relationship and do not carry the protections of confidentiality that would normally apply. Everybody will let you know where they can practice or help you. Patricia Van Haren and I are licensed to practice in California only, and so the legal information that we'll give briefly is only based on California law. So I think that I'm going to turn it over to Susan Piazza.
Tommy.
Actually, yeah, this is mine. So thanks for the introduction. My name is Tommy Evans, and I'm a certified mortgage advisor, and I specialize in divorce mortgage. And really, I kind of want to spend a little bit of time just explaining to you where the market is and where we see that heading. And so interest rates really peaked back in November to 20-year highs. And so since then, they've slowly been coming down. And we're going to see them continue to come down. And I'm going to kind of talk a little bit about why. So next slide, please. Okay, so one of the key things that a lot of people don't understand about inflation is how it works. And so really what they do is they take a reading each month. And so it's a month over month reading, and it's a 12-month accumulation of each one of those monthly readings. And so we just had the most recent consumer price index reading for March that just came out. And that was a really low reading. Graphs a little bit old, but you can see kind of in the middle there, it's a 0.3 for March of 2022 reading that was just replaced with another reading of 0.3. So we saw inflation actually stay about the same on the core reading. Now we did see year over year inflation come down. So we're seeing over the next 3 months, you've got the April reading 0.6%, May, June. Those are actually very high readings that are going to be replaced with much lower readings. We anticipate like the rest of the summer, we're going to have very low inflation readings. And so we're going to see inflation really come down over the summer and all the way like through August, even, into the end of the year. Next slide. So why am I even telling you about inflation? Because inflation really is on the way down. And what that does is that drives interest rates. Next slide, please. And so as inflation comes down, mortgage rates will also come down. And so you can kind of see on this graph that they pretty much mirror one another with the exception of during the quantitative easing. So you can see basically from March of 2022 through January of 2022, interest rates on that yellow line stayed very stable. That's because the feds were buying a ton of mortgage-backed securities, a ton of treasuries, and keeping those rates artificially low. And then back in February of 2021, the inflation really started going up. I don't know if you remember, but they were saying, oh, inflation's transitory, it's not gonna last, and the feds are clueless, honestly, with what they're doing. And they got it wrong then. They're getting it wrong right now. They continue to raise rates on the Fed's fund rate, and they're going to, unfortunately, send us into a recession. And the only silver lining here is that mortgage rates are going to come down because they're overdone how many rate hikes they should do. They're going to kill our economy. That's the great news, right? Sorry, but it's just kind of what our government does. They go extremes one way and extreme the other. And right now we're in a situation where they're pushing things really too far with how much they're raising rates. They're not waiting to see what those effects are going to take place, because these are lagging effects. Like, it takes time for the economy to slow down. We're already seeing that, but they're still looking at this inflation number that they're trying to push down to 2%, and they're just being impatient. Next slide, please. So right now we're in a situation where rates are really, pretty high. And so it's going to take, like I said, really the rest of this year for them to really make a comeback and come back down. So what can you do in the meantime? So really, there's a couple options to look at. One is a temporary buy down, where we can actually buy down your interest rate up to 3% lower than current market rate, and have that payment be considerably lower. These are tough to do these days because you have to get the seller to pay that difference in rate. And so they're going to pay the interest really for the first 3 years for you, that difference between what the actual rate is and what that temporary buy down rate is. And so that's something you have to negotiate when you're making offers on a home. Back in just even earlier this year, we've seen that those were a lot easier to get accepted. Really, you'd come in, you make an offer a little bit over ask, and then you'd ask for a credit. And so that's kind of how we were able to get a lot of those done. Now we're seeing the market has shifted. There's already a lot of homes that are starting to get multiple offers, especially if they're priced right. And Susan's going to tell you a little bit more about that. But we're seeing that as rates have come down again, there's more and more buyers come out to the market, and we're seeing all of a sudden prices are stabilizing and even starting to go back up again. And so the whole idea that we're going into a housing crash, honestly, it's nonsense. And so that's the first thing I think it's important to know. Now, other mortgage related options is to go for an ARM. You can look at this as, I can go as little as a 6-month ARM. And you might think that's crazy, but I'm telling you, you will not hold a mortgage longer than 6 months if you take it out today. And so why would you want to pay a significantly higher monthly payment if you know you're going to refinance in the next 6 to 12 months? And so you could look at this as a little as a 6-month ARM. You can have it fixed for the next 3 years, 5 years, 7 years, 10 years, whatever you're most comfortable with. So it's not just let's take out a 30-year fixed or a 15-year fixed. You do have options to consider. Next slide, please. So there's different ways to kind of look at how we can help you with your home. And so, whether that's going to be doing a cash out refinance, if you want to sell your home and buy something else, if you just want to rent for a little bit. These are all things that we can help you run the numbers on and make sure that you're making an informed and educated decision that, you want to know ahead of time. So if you, think that you're going to keep that home and you're just going to do a cash out refinance to pay off your significant other, you're going to be shocked when you see, rates are no longer at 2%. All of a sudden you're going to be looking at a 5-6% interest rate. And that's going to change the numbers. And it's important that you have those numbers. And so the other thing is going to be income. And so all of a sudden, when you're going through the, divorce process, you may have, support that you're going to have to pay. That's going to affect your debt to income ratios. And so taking into account all of these different potential, debts and how much it's going to cost you, you want to know these numbers up front. We want to make sure that you understand that you're going to have lots of options where, we can get creative with the financing. We can look at setting up a trust and using trust income where we don't have to, maybe you're a stay-at-home parent and you don't have a job, or maybe you're going to be taking a job that's got an hourly pay and we need 6 months of, pay before you can be able to use that income. So there's ways that we can, find income for you that if you quite frankly walked into a bank and asked them if they could do a no ratio loan, they're going to have no idea what you're even talking about. And so I'm happy to have these conversations with you to see what we can do to help you get into that home, or keep the home that you have. And honestly, the very most important thing I want to leave you with is, if you do have a mortgage in place right now, most likely it's below 3%. There's ways to keep that. So I'd love to talk to you and see if that's something that we can help you figure out, how to keep that rate. But, I'm going to turn it over to Susan, and she's going to kind of explain to you, some of the different things that she can do. She specializes in divorce, and, there's no better person to talk to if you're thinking about selling your home.
So, right now, as Tommy mentioned, we do have a crisis when it comes to inventory. We are super, super low, historically low, and that has, even with the higher rates, driven prices. Right now, listings are key. The fact that also finding a home for rent is very difficult. So if you're able to stay in the home and possibly do what we call a rent back, that has been really, really helpful. So what that means is that you're able to be in the home, open escrow, close escrow, split the proceeds, and then that would give you maybe a month to 2 months in order to maybe purchase another home or find something to rent. If we go over the next slide. You'll hear a lot of people talk about there are foreclosures, and foreclosures are coming. Right now, foreclosures are at a historical low. They were, you'll notice, a little bit lower in 2021, and that's simply because the middle half of the year was when the foreclosure moratorium ended. So if you look at our foreclosure rates, they do seem a little bit higher. Some people will say, oh, they've doubled. Well, they doubled from a year where they weren't allowed for half the year. Right now, historically, there's a number that lenders look for. It's called 0.08. That's the percentage of foreclosures that they have in all of their portfolio. We're right now at 0.04. Average house right now has about 53% equity in it. So people aren't going into foreclosure. So I personally wouldn't be looking for that to be an option. Next slide, please. Listing inventory here in Orange County, again, we are at a historic low, and there just simply aren't enough homes, supply versus demand. And we're in a point where I don't really see that changing very much. In the summer months, June, July, and August, we do see the market slow a bit, especially post-COVID. People go and take vacations because school starts again in August. The last 4 years, we have seen an increase, August, September, October, of more sales and more homes coming on market. And then that kind of pretty much winds down for the rest of the year from mid-October on. Next slide, please. As Tommy mentioned, mortgage rates have really powered this market. Even though they are a little bit up higher, if you look at the number of mortgages, people aren't wanting to sell, like possibly many of you. 70% of mortgages are under 3%, 90% are under 4%, and 99% of the mortgages in the United States are under 6%. Next slide, please. So one of the things that we talk about is if you do need to sell the marital home, some folks are able to do a buyout. If you are interested in possibly buying your spouse out, make sure you talk to Tommy, make sure that he can get you qualified for that refinance mortgage. Talk to Glenn. There are some other options that they have that are very creative in order for you to be able to buy your spouse out. What I can offer you is a comparative market analysis. So I can tell you what the house is worth approximately. Please do not spend the money on an appraisal. Appraisals look at value in the past. They look at the numbers for the last 6 to 12 months. They're not looking at homes that are in escrow, and they're not looking at the homes that maybe might not be listed. When I go into an area and I do a market analysis, I typically am able to find out what homes are coming on market. And a lot of times the agents will share with me what homes will be closing at. So if you see a house in escrow down the street and you ask the agent, what are you going to close at? What will that home actually sell for? They typically aren't able to share that with you for different fiduciary reasons, but it's something that I can typically find out. That will result in a very accurate value. Also, appraisals are expensive. You're looking at anywhere between $6,500 to, I've seen some that were $1,500, $1,800. So market analysis is no cost, and I will update them as needed too. So as time goes on, obviously property values change, and I can update those to the latest comps. Please, whatever you do, don't get one of those. But if you do want to spend some money, it's always a really good idea to have a home inspection. Spend $450, $550, have a professional inspector come out and look at the home from top to bottom. Find out if there's any maybe leaks that you haven't seen, any deferred maintenance. That way, when you're doing that buyout, let's say that the roof has 10 years left on it, you're able to find out what the cost of that is and include that in your negotiations. So strongly recommend spending a little bit of money on a home inspection. Obviously, both parties want to get the most out of the home's value since it typically is the largest asset. We stage complimentary. We do light furniture and accessories. We also do virtual staging in probably about all the homes that we have right now. We use professional photographers. We have 2 to 3 that we use. Strongly advise professional photographers, and there are different levels of professionals. I have seen professional photography for $100 that, well, to be honest, looks like something I might have taken. And then we have some photographers that just do stellar work that are true artisans in their craft. Those are the folks that we prefer to use. You have about 2 seconds to catch somebody's attention when they're looking at homes on things like Zillow and Redfin. We also take care of the cleaning prior to the open house. So that morning, while you're getting maybe kids, dogs, etc. out, we send a cleaner to shine things up and make it pretty. We have pricing strategies and marketing strategies. I typically will meet with each party alone and then present a marketing and pricing strategy that both parties will agree on. Pricing a home is very, very important, and you can overprice them very easily, even in a low inventory market. There are still a lot of homes out there that have been sitting on the market for 3 to 6 months because they were overpriced and not properly presented to the market. So, and if I can go through pricing strategies, like I said, with both parties and make sure that everyone's on the same page. It's a very seamless process. Next slide, please. So if you would like a CMA, a market analysis, there's a couple ways I can do that. If you're in a position where you haven't, you're just now looking at possibly filing, not sure if you want a divorce, but curious what the house is worth, you can send me some photographs and I can put together, kind of a draft market analysis and give you a ballpark idea of what the home is worth. Obviously, it's always best if I see it in person. Very difficult to judge what a house is worth without being there. But like I said, I am willing to do that for the Vesta clients. I will pass it on to, I believe, Elizabeth or Glenn. Thank you.
Thank you so much. I always learn so much hearing from our professional real estate team. I don't know about you, Elizabeth.
Absolutely.
I am Patricia Van Haren, and I am the collaborative attorney and mediator in the Irvine Vesta Hub. What that means is I'm a family law attorney, but all of my cases are resolved outside of the courtroom. I'm here with my wonderful colleague, Elizabeth Johnson.
And my partner and I take cases through the court process for whatever reason. If parties can't agree, or they can agree on most issues, but not all issues, we take those last remaining straggling things to court so that we can have, get parties a resolution and get them on their way.
So we're going to talk to you about some family law issues as it relates to the home. One of the laws that we really want to look at in regards to the home, we're looking at California Family Code 2640. And what that discusses is what happens if somebody takes their separate property and they use that as a down payment on the house. A lot of people will say, well, I paid the down payment, so this whole house should be my separate property because I took money from my retirement or I sold a home that I owned prior to marriage. What the code tells us is that if you use your own separate property for down payment, you are entitled to a dollar for dollar reimbursement on that property, assuming that there's enough money when the property is sold. And you are going to have the burden of proof to show where that money came from. What was the source? So we look at that, and that's called tracing.
Right. And it can go far, it can go as far back as you can prove. So, you were married 30 years ago and you bought your first house together and there was a down payment to that house and then you rolled that house into the next, fine. If you can prove that you made it, on the first house and that every house has made a profit since then, absolutely, you can trace it through. And it's a long process, but it's worth it, depending on what your down payment was.
Then the other law that pertains to houses that we look at, you'll hear often the terms Moore Marsden. What that really is are two cases, the marriage of Moore and the marriage of Marsden. And that involves when the community gains an interest in somebody's separate property residence. So let's say somebody owns a house before marriage. They don't do what's called transmuting, which is changing the characterization of the house. The house remains that separate property. However, during the marriage, the parties are making payments towards the mortgage of the house. Then the community will gain an interest in the house.
And this often happens without people realizing it because you do the same thing that you were doing before you got married. Spouse moves into the other spouse's residence that they already own. And once you get married, that payor spouse's income becomes community property. And so now community property is paying the mortgage, not separate property. And so it's often, unintended or not intentional, but it does create a fractional interest that needs to be figured out. And while that property will likely stay, the separate property of the spouse that had it before, there may be an interest that needs to be bought out or compromised elsewhere.
So just some key points. So California is a community property state. So that means any property acquired during the marriage is considered community property and is owned equally by both the spouses. So that means if you bought your house during the marriage and only one of the spouses' name is on title, it doesn't change the nature of the property. So it still is community property. So regardless of who paid for it. So if we have one spouse that's working during the marriage, the other spouse stays home, absent any agreement to the contrary, that income is still community property.
Right. And so when a couple files for divorce in California, there's really a handful of things that can happen with the property. One spouse decides to buy the other one out and uses Tommy's services to refinance and get that cash for the buyout. Parties agree to list the property for sale and they use Susan to list it, or they agree to defer the sale for a short period of time. Maybe your eldest child or your youngest child is finishing high school. and you're going to wait 2 years to see what happens and make some arrangements to sell it in the future. But really, something's happening with the house, and if you can't reach an agreement that works for your family, the court will order it sold at trial. Usually not before trial, unless someone's not paying for it, but the court will order it sold. So keep that in mind.
And if you are going to continue to co-own your home after the divorce, you really want to put down in writing and have an agreement. How are you going to share the expenses, the responsibilities, such as the mortgage payment, property taxes, any maintenance costs? You really want that outlined in your final judgment before it gets filed with the court.
Right. And so as the divorce is pending and hopefully as the home continues to increase in value, that increase in value is still considered community property. It's valued as close to the time of trial or sale as possible. And where other accounts are valued as a date of separation, this is not one of those things, because the market will continue to fluctuate while you own it jointly.
With that, we're going to turn it over to our financial team.
Hello, everyone. My name is Gregory Schmidt, and I am a certified divorce financial analyst, just as Glenn is, who spoke with you earlier. We're part of a firm called Strategic Divorce Planning, and we've got a group of CDFAs, CPAs. We've got a ton of experience, and we really touch on every financial component as you go through the divorce process. And our goal is really to help you get positioned such that you can support your life after divorce. And so that's really our goal. And so when we take a look at what we've got on our slide here, the power of preparation is immense. Okay, so a really easy way to put this is you got to understand what your financial position is today in terms of cash flow, in terms of assets, in terms of debts. You've got to understand what your financial position is going to be once your divorce is finalized, day one of your divorce. And you've got to understand what your financial position is going to be in the future, 10, 15 years down the road. The decisions that you make as you go through this process are really going to have implications for all of those points in time. And so to get started preparing for your divorce, you want to just start making a list of all of the facts, all of the things that have existed throughout your marriage. When did you acquire certain things, right? So when did you acquire your real estate? Was it something that was brought into the marriage from just previously? Was it something that you bought during the marriage? How many times? When did you refinance? And what were the terms of that refinance? Collect paperwork to support all of the things that you list. Okay. Now, when it comes to the home, usually one person has an interest in staying in the home. And the big question is, can we make that happen? Are you going to be okay once you do that? And by getting prepared and getting all of the data in one place, it helps you make that decision, because, it's a matter of, can I afford it? Can I qualify? But then can I also support the lifestyle that I want to live once I refinance, once I do the buyout, once I do all those things? Am I going to be able to then support the lifestyle that I want to live? The worst thing that could happen is, you end up doing a buyout, you keep the home, and then a couple years down the line, you decide, this is putting undue pressure on my lifestyle because my cash flow situation is such that, it's a little too tight. If you sell it, after the fact, if you sell the home after the fact, you'll miss out on a huge capital gains tax exclusion opportunity that you have when selling the marital home while you're still married. And so in order to answer that question, you got to understand what you want your lifestyle to be. And so you want to map out your future. You want to understand, okay, this is what I want my life to look like. And so to do that, you're going to need to get a good understanding of what your expenses are, and you're going to need to get a good understanding of what your inflows are going to be. If you aren't working, then it may be that you stand to receive some amount of support from your soon-to-be ex-spouse. You need to understand what that's going to look like. And so before you can answer the question, do I want to stay in the home? You got to be able to answer the question, you know, what is my cash flow situation going to look like? And so oftentimes that is the key pressure on this decision is, can I qualify? And then can I support my lifestyle afterwards? And so once you've mapped out what you want your lifestyle to look like, then we can start looking at the tools that you have to support that lifestyle. So if you don't have income, but you have assets, we can help you generate income from those assets. And we have a lot of creative ways to give you sustainable income into the future. And so that's where we start designing a plan. That's when we start making decisions about asset division. That's where we start really solidifying scenarios in which things work out. And so we can line them up side by side, and we can say, hey, you know, in this circumstance where you keep the home, this is how much money you're going to have at the end of the month, or this is the gap that you're going to have at the end of the month that you're going to need to close in one way, shape, or form. And so what you want to do is you want to just take it step by step. It can sound like a lot at the beginning. Begin by just getting prepared, getting all of your information in one place. You know, work with your professionals to understand what you qualify for and what impact that's going to have on your expenses. And then when you're mapping out your future, you get to look forward to what your life can look like. And so that should be a really positive experience for you. And once you do that, you're going to be able to see, you know, scenario A, scenario B, if I keep the home, if I sell the home, what it's going to look like. And that's when your decision really is going to be easy. And so with that, I'll hand it over to Glenn, and he'll be able to tell you his 5 isms.
Okay, great. I
We'll
want
wrap
to
things up.
add a little bit on Greg. Yes, you know, we are CDFAs. We're financial advisors, but we have a specialty, which was, you know, pretty arduous process to, you know, to get to have expertise in marital asset division. You're negotiating a deal. It's like dissolving an enterprise, the marital corporation. And what we espouse people should do is put themselves in a position of making decisions from a position of knowing. And really, all the work that we do helps people understand the impact of those decisions, i.e. how to divide the assets, taking into account taxes, risk, liquidity, and income, and answer the question that everybody asks Greg and I, which is, am I going to be okay? How to make sense of it? Our practice does work with people all over the country. We're not restricted by states. We are comprised of CDFAs, analysts, CPAs, business valuation people, and forensic accountants. So we can handle everything having to do with the financials. All right, so I'm going to give you what I call my 5 isms of divorce. It's something that I believe everyone should know about divorce. And some of them may seem as plain as the nose on your face, but people often still need to hear it. Because sometimes one spouse will say, oh, I'm not giving you any of my pension, or I'm not giving you any of my 401k, or, you know, whatever it happens to be. We do have to identify community property and separate property, which was talked about a little bit earlier, but any question you have will fall into one of these 5 categories. I haven't found one that doesn't yet. So the first one is, you're a 50% partner in the marital enterprise, the marital corporation. You are entitled to 50% of what you and your soon-to-be ex acquired during the course of the marriage. Whether you are a big-time lawyer or a business owner or a super salesperson or the CEO of the home, you're a partnership. And just as if you were dissolving a business that you were a partner in, I'd imagine you'd want to know how much is in accounts receivable, how much is in accounts payable, how much do we have in inventory, what's in work in process, what's our intellectual property, what contracts do we have signed, the whole shebang before you made a decision, an informed decision. And same thing here. You are responsible for half of what you acquired, and you're entitled to half of what you acquired, and you're responsible for half of what you incurred. The trick is, how do we divide it up? Again, taking into account taxes, risk, liquidity, and income. Number 2, everything in divorce is negotiable. Every single aspect of it is negotiable. The date of separation is negotiable. Spousal support is negotiable. How much it can be on a monthly basis or maybe a buyout. All assets are negotiable. Child support is negotiable. Everything is negotiable. It's negotiated. Number 3, you and your soon-to-be ex can agree on anything that you want to agree on. Absent a judge, an attorney like Elizabeth or Patricia, or an advisor like Greg and myself. You can agree on whatever you want to agree on, meaning you can relinquish something you're entitled to. Now, we encourage people not to make emotional decisions, and a lot of times people are bound to do that in a situation that's so highly charged. But we don't want you to make an emotional decision that is to your detriment. It's rarely divided 50-50. No one ever takes everything right down the middle and splits it 50-50, because it can be costly and have negative impact on you. So again, the trick is, how do we move things from one side of the ledger to the other to have an equitable resolution? And that's what the court wants. But you and your spouse can agree on whatever you want to agree on, as long as your spouse hasn't lost their mind. Now, some people might suggest that their spouse is cuckoo, but they have to be diagnosed as such. Number four, marital asset division and divorce is essentially final. You can't renegotiate it unless you can prove fraud, which is timely and costly. That's why we want to get all the data up front, and we want to identify any data that we think is missing. Now, if you weren't the person who handled the finances in the home, generally you still have knowledge that, my soon-to-be ex said they had cryptocurrency, because everyone brags about how much money they make in that cryptocurrency, or we were a part of a real estate investment trust or some other investment. You may not have a statement, but you have knowledge of it. At that point, we can have the lawyer help us discover that information. We want all the information so we can take it all into account, value everything properly, calculate what it's going to look like for you in terms of your post-divorce life. That's a stage we call life after divorce planning, or we do an income analysis that matches up against scenarios that our team might produce for you. So okay, I see how it's divided. What does it mean to me? How am I going to make sense of it? And if marital asset division is essentially final, that means number 5, you got to get it right. So those are my 5 isms of divorce. And it's titled the 5 isms because my dad, the colonel, said, son, there's very few universal truths, but there's a lot of general truths. So these are my 5 generalisms about divorce.
Excellent. Thank you, Glenn. We have one question, Patricia, and it may be best suited for
let me stop. Let me stop our recording before we get to our Q&A. So we'll have all our panelists come on. We want to thank you, and I'm going to go ahead and stop our recording. We'll get to the questions and answers. Give me 1 second.